September 15, 2008. Lehman Brothers, a 158-year-old Wall Street giant, files for bankruptcy. This wasn't just another corporate failure. It was the largest bankruptcy in U.S. history, with over $600 billion in assets gone. And it was the spark that lit a global financial wildfire. So how did a bank that survived the Civil War, 2 world wars, and the Great Depression collapse almost overnight? Let's break it down. Lehman Brothers began in 1850 as a small cotton trading business in Alabama. Over time, it grew into a Wall Street powerhouse, and by the 2000s, they were everywhere. Investment banking, trading, asset management. But what really fueled its rise? Mortgage-backed securities. Though these complex financial products would soon make and break the bank. In the early 2000s, U.S. home prices were on fire. Banks raced to issue as many home loans as possible. Why? Because they could bundle those loans into investments and sell them for profit. So Lehman went all in, not just with safe mortgages, but with risky subprime loans. These were loans given to borrowers with poor credit, little income, or no documentation. Well, why take the risk? Because higher risk meant higher returns, and for a while, it worked. By 2007, Lehman's stock price had soared from $20 to over $80. Of course, the shareholders were thrilled and executives were rich. But beneath the surface, cracks were forming. By 2006, home prices stopped rising. By 2007, they were falling. Suddenly, borrowers started defaulting. The subprime mortgage market began to unravel, and the once profitable mortgage-backed securities, they were quickly turning into toxic assets. Lehman was sitting on tens of billions in these investments, and no one wanted to buy them. As losses mounted, investors panicked. Lehman's stock plummeted by 73% in just 6 months. Creditors started pulling their money. The bank was bleeding cash. Frantically, Lehman searched for a lifeline. Barclays and Bank of America considered a deal, but ultimately both walked away. No one wanted the toxic mess on Lehman's balance sheet. By September 2008, Lehman was cornered, with no cash, no buyer, and no rescue. Alas, on September 15, 2008, Lehman Brothers filed for bankruptcy. It was carrying over $600 billion in debt, the largest corporate collapse America had ever seen. The aftermath was immediate and brutal. Markets crashed, banks froze lending, panic spread around the globe. In just one weekend, confidence in the entire financial system shattered. The U.S. government rushed to contain the damage. It bailed out institutions like AIG and passed trillion-dollar rescue packages. But for Lehman, it was too late. Over 25,000 employees lost their jobs. Investors lost everything. The collapse also gave birth to new regulations like the Dodd-Frank Act, aimed at preventing another meltdown. However, the scars of 2008 ran deep in the economy, in public trust, and in how we view risk. Lehman Brothers wasn't just a victim of a housing downturn. It was a product of unchecked risk, inflated confidence, and a belief that the good times would never end. The 2008 financial crisis showed that in a global system, one giant's fall can bring down others fast. It exposed how fragile things really were. Have we learned from it? That's still an open question. But one thing's certain, Lehman's collapse is more than a history lesson. It's a warning. Follow Trading Key as we uncover more market stories behind the world's biggest financial events and the lessons every investor should know.